Hi students, good morning. I am Dr. Majini Desbella, Assistant Professor. In this class, we are going to learn about admission of a partner. Unit 14, Block 4. First, we can see the introduction of admission of a partner. According to the Partnership Act 1932, a new partner can be admitted into the firm only with the consent of all the existing partners unless otherwise agreed upon. With the admission of a new partner, the partnership firm is reconstituted and a new agreement is entered into carry on the business of the firm. Inclusion of a new person as a partner to an existing firm is called the admission of a partner. The new partner who joins the business is called the incoming partner or new partner. Then we can see the rights of incoming partners. For acquisition of the rights to share the assets, the new partner has to bring an agreed amount of the capital. For the right to share profits of the partnership firm, the new partner is required to bring some amount which is known as premium on his share of goodwill. Then we can see the accounting adjustment. Admission of a partner necessitates the following accounting adjustment in the books of the firm. The first one is ascertainment of new profit sharing ratio. Second, calculation of sacrificing ratio. Then revaluation of assets and reassessment of liability. Then distribution of reserve and accumulated profit or loss. Then treatment of goodwill, adjustment of capital. The new profit sharing ratio. New profit sharing ratio is the ratio in which all the partners share the future profits and losses. The mutual profit sharing ratio among the existing partners may remain unaltered after giving away the new partner's share. I have given example for your easy understanding. Listen the question and the answers carefully. X and Y were partners sharing profit and losses as 3 is to 2. The ratio is 3 is to 2. That is the older ratio. They admit as a new partner giving him 1/5 share of future profits. What should be the new profit sharing ratio? We can see the solution. Is it share, the new partners share 1/5, right? Balance 1 minus 1 by 5 is equal to 4 by 5. Okay, X share. First, we can calculate the ratio of X, the share of X. 4 by 5 into 3 by 5. 3 by 5 is the old ratio, old share, but 4 by 5 is the new share. Okay, 4 by 5 into 3 by 5, you will get 12 by 25. But we can see the Y's share. Y's share 4 by 5 into 2 by 5. 2 by 5 is the old ratio. Okay, so here the total is 8 by 25. Then we can see the Z's share. That is 1 by 5 equal to 5 by 25. Why? Because already X share 12 by 25, Y's share 8 by 25, but Z's share only 1 by 5. We should change the denominator. So we should multiply by 5. So you can get 5 by 25. So the new profit sharing ratio is 12 is to 8 is to 5. Okay. So the mutual profit sharing ratio among the existing partners may be changed by the agreement. Okay. So here one more example I have given. Just I wanted to read the question. A, B and C. 3 companies are there. 3 partners are there in the one company. A, B and C were partners. They are sharing their profit and losses as 3 is to 2 is to 1. They admitted D as a new partner, giving him 1/6 share of future profits. D acquired 3/24 share from A and 1/24 share from B. Calculate the new profit sharing ratio. First, we can see the solution part. Listen carefully. New ratio is equal to old ratio minus sacrifice ratio. Old ratio minus sacrifice ratio. Here the old ratio, how much for A? A is equal to 3/6, right? Because 3 is to 2 is to 1. So the what is A is equal to 3/6. Okay. So the acquired 3/24 share from A. So 3/6 minus 3/24. When you are calculating, you will get 12/24 minus 3/24. When you are solving this, you will get 12/24 minus 3/24 equal to 9/24. Okay. For B also we should calculate. For B, 2/6. Here is the 2 and this is the total 2/6 minus 1/24. Here is the 1/24 share from B. Okay. So that 2/6 minus 1/24. When you are solving this, you will get 8/24 minus 1/24 is equal to 7/24. Then you come to this C. For C, 1/6, right? Here there is no sacrificing ratio. So the sacrificing ratio is nil. So you will get the answer 4/24. When you are solving this, you will get 4/24. Okay. So the new ratio is 9:7:4 for the old partners. But the new partners 3/24 plus 1/24 because the A and B are sacrificing, right? So 3/24 plus 1/24. You will get 4/24. So the new ratio is 9:7:4:4. Then we can see the sacrificing ratio. The ratio in which the old partners sacrifices or surrender their share of profit in favor of new incoming partner of the organization is called the sacrificing ratio. Sacrificing ratio is equal to old ratio minus new ratio. Okay. So then we can see the revaluation account. A revaluation account is a nominal account prepared to bring the asset and liabilities of the firm to their true values and to find out the profit or loss arising therefrom. The revaluation account records the positive or negative holding gains occurring during the accounting period to the owners of financial and non-financial assets and liabilities. I have given some of the journal entries. First, for increase in the value of assets. The journal entry is assets account debtor to revaluation account. Assets account debtor to revaluation account. Then, for decrease in the value of assets, what is the journal entry? Revaluation account debtor to asset account. Okay. Then we can see for increase in the value of liability. For that revaluation account debtor to liability account. Then for decrease in the value of liability, the journal entry is liability account debtor to revaluation account. Okay. Then for recording unrecorded assets, that is assets account debtor to revaluation account. Assets account debtor to revaluation account. Okay. So the next one is for recording unrecorded liability. For recording unrecorded liability. That is the journal entry is revaluation account letter to liability account. Revaluation account letter to liability account. Then we can see for transferring profit on revaluation. For transferring profit on revaluation. What is the journal entry? Revaluation account letter to old partners capital account. Okay, revaluation account letter to old partners capital account. Then transferring loss on revaluation. For transferring loss on revaluation. The journal entry is old partners capital account letter to revaluation account. Old partners capital account letter to revaluation account. The pro forma also I have given the pro forma of revaluation account. First we can see debit particulars amount. The credit side date particulars amount. The debit side also date particulars amount card. Okay. First we can see what are the items will appear in the debit side. Decrease in value of assets, increase in reassessment of liability and capital accounts, liabilities and capital accounts, gain or revaluation. Okay, so here we can see in the credit side, increase in the value of assets, decrease or reassessment of liabilities, capital account loss and revaluation. Here, gain on revaluation. Here, loss on revaluation. Okay, then we can move for the methods of treatment of goodwill. First, premium method, then revaluation method, then memorandum revaluation method. Okay, three methods of treatment of goodwill are there. Premium method, revaluation method, memorandum revaluation method. First, we can see the premium method. Under this method, the new partner brings in his share of goodwill in cash. The amount of premium brought in by the new partners is shared amongst the old partner in their sacrificing ratio. Journal entry also I have given for your better understanding. See here the journal entry. For bringing the premium, that is the share of goodwill. The journal entry is cash and bank account letter to goodwill account. Already in the previous classes, I told you, whenever you are going to write in a journal entry, just you remember the golden rules of the accounting. Okay. When you are remember that, it is easy to write the journal entry. Okay. So here cash or bank account letter to goodwill account. Then for transferring goodwill to the capital account of all the partners in sacrificing ratio. The journal entry is goodwill account letter to old partners capital account. Okay, goodwill account letter to old partners capital account. Then by combining the above two entries, one entry may be processed as follows. Okay, the combination of the above two entries. That is cash or bank account letter to old partners capital account. Cash or bank account letter to old partners capital account. Okay. Then we can see the goodwill brought in cash is withdrawn by old partners. If the partnership agreement so permits the old partners can withdrawn either fully or partially the amount brought in by the new partners for goodwill. In such cases, two entries are given in firm's book. First, we can see what are the entries are there for the amount. See here for the journal entry, here I have given for the amount brought in for the organization for goodwill purposes. The journal entry is cash account letter to old partners capital account. Okay. The next one is on withdrawing the amount by old partners. That is the journal entry. Old partners capital account letter to cash account. Okay. This is the journal entry. Then we'll move for the Journal entry for the goodwill premium brought by a new partner transferred to the capital account of old partner. What is the journal entry? Cash account debtor to old partner's capital account. That is most important. Then we can see the journal entry for unpaid amount of goodwill premium credited to the capital account of old partners in sacrificing ratio. That is new partners capital account debtor to old partners capital account. New partners capital account debtor to old partners capital account. Next we can see the revaluation method of treatment of goodwill. Under this method, the new partner does not bring in his share of goodwill in cash. Instead, a goodwill account is raised to the firm's book. Goodwill account is created in its full value of crediting the amount in the old partner's capital account in their old ratio. The goodwill account should be shown on the side of the balance sheet. The journal entry for raising the goodwill is goodwill account related to old partners capital account. Then we can see the memorandum revaluation method. Under this method, goodwill is raised in the books at its full value and written off immediately after admission. On raising the goodwill, the value is credited to the old partners capital account in their older ratio. And on writing it of all partners, including the new partners, capital account are debited with the value of goodwill in their new profit sharing ratio. The journal entry also I have given here for your better understanding. For the first journal entry is goodwill account related to old partners capital account. Then full value of goodwill shared in older ratio. What is the journal entry? All partners capital account related to goodwill account. Okay. Then we'll move for the next part. The journal entry for the recording of transactions. The assets brought by the new partner. What is the journal entry? Asset account data to new partners capital account. Assets account data to new partners capital account. Okay. And then the if any goodwill are there now, that goodwill also will write here. That is the journal entry for assets brought by the new partner, asset account data to new partners capital account and the premium account are goodwill. Okay. So then for transferring the amount to the capital account of the sacrificing partners in the sacrificing ratio, that is goodwill account data to sacrificing partners capital account. Okay, then we'll move on the next part here. I have given some of the example also. Illustration. First we can see the illustration. First I just wanted to read the question. X, Y and Z partnership sharing profits and losses in the ratio of 3:2:1. Their balance sheet stood as under. Balance sheet as at 1 for 2012. First, I just wanted to read the liability side. Capital X capital 40,000, Y is capital 30,000, Z is capital 20,000. Total capital is 90,000. You should write it in the debit side. Okay. Then what is that? The general reserve. First, you should see the general reserve 12,000. Machinery replacement fund 16,000, investment fluctuation fund 15,000, current liabilities 5,000. Okay, you come to this asset side. Fixed assets 80,000, machinery replacement 15,000, investment. Okay, current 10,000, then assets 33,000. Both sides the total is 1,38,000. Just show the journal entries for accumulated profits resource, assuming that Mr. T is admitted as a partner for 1/5 share. We start the solution for journal entry. You should write date, particulars, ledger folio number, then debit side as well as the credit side. First, we can write it general reserve. General reserve how much? 12,000, right? So you can write it. General reserve 12,000. Investment fluctuation fund how much? Investment fluctuation fund 12,000. Total amount here 15,000. Okay, minus 3,000. Total how much? You should write it 12,000. According to X capital account 12,000, Y capital account 8,000, and Z capital account 4,000. Because accumulated profits are distributed 3:2:1. Okay. So then one more illustration I have given. See here. I just wanted to read the question. A and B are partners in a firm sharing profits and losses in the ratio of 4:1. Their balance sheet as on 31st March 2013 stood as follows. Within the balance sheet, liabilities, then asset side. Come to this liability side. I just wanted to read the liability side. Capital account. Okay, capital account A 25,000, B 65,000. Okay, total capital you should write it 90,000 in the outer column. Okay, 90,000 in the outer column. Then reserve 20,000, creditors 25,000, bills payable 5,000. Come to the credit side, furniture 20,000, stock 40,000, bills receivable 10,000, debtors 30,000, cash at bank 40,000. Both sides total 1,40,000. Okay, they agreed to take C as a partner with the effect from 1st April 2013 on the following terms. A, B, and C will share profit and losses in the ratio of 5:3:2. C will bring 20,000 as premium for goodwill and 30,000 as capital. Half of the reserve is to be withdrawn by the partners. The assets will be revalued as follows. Furniture 30,000, stock 39,500, debtors 28,500. Then a creditor of 12,000 has agreed to forgo his claim by 2,000. After making the above adjustment, the capital accounts of A and B should be adjusted on the basis of C's capital by bringing cash or withdrawing cash as the case may be. Show revaluation account, partners capital account, and the balance sheet of the new firm. Okay. Next, we'll move for the solution part in the books of A, B, and C. The debit side, you should put particulars column, amount column. The credit side also, you should write a particulars column. Then you should write the amount column. Stock 500, provision for bad debts, that is 1,500. Then to profit on revaluation, right? The credit side, you come here, furniture 10,500, creditors 2,000. Okay, furniture 10,000, creditors 2,000. Okay, just to put the total 12,000. Just to subtract it, you will get the profit on revaluation for A 8,000, B 2,000, right? Then you come to this next part, capital account. Particulars for all the three partners, we should write it right. So you can write some of the workings also I have given. Okay. For the sacrificing ratio and some other workings also I have given. Then here, particulars A column, B column, and C column. The credit side also particulars A, B, C, all the three partners. 2A is capital. 2A is capital. The column We write, we should write it 10,000. Before that, just to see the question here for capital A 25,000, for capital B 65,000. That is the opening balance. Okay, you can write here opening capital by balance BD for A 25,000, for B 65,000. Then you can see C brings 20,000 as premium for goodwill and 30,000 as capital, right? So that also you have to write it here for C 30,000 as capital. Okay, so we can write it by bank in the C column. You can write it 30,000. Okay, to bank for A 8,000, for B 2,000. Here is the amount, already we got it. Okay, first we can see the, before that we can see the sacrificing ratio, sharing of goodwill, sacrificing ratio. A is equal to 4 by 5 minus 5 by 10, which was mentioned in the question. See the question there. You will get 3 by 10 is the sacrifice. Okay. For B, 1 by 5 minus 3 by 10, you will get 1 by 10. That is gain. For C, 2 by 10. Okay. So here, the goodwill to be credited to A's capital account, B will have to pay A for goodwill. That amount also I have given the workings. See here, the amount 20,000, right? Already I have read out 20,000 into 10 by 2, right? Into 1 by 10. You will get 10,000. Okay. For adjustment of capital, C brings for 210. That is the 30,000 capital. So A will have to bring for 510. That is 30,000 into 5 by 10 into 10 by 2. You will get 75,000. And B should bring for 3 by 10, right? 3 by 10. That is 30,000 into 3 by 10 into 10 by 2. You will get 45,000. Because B is bringing the capital 30, the new partner is bringing the capital 30,000, right? Just to listen. Again, you should read out the question. When you are reading the question, you will get more ideas about this. So then we'll move for the capital account by balance BD 25,000 for A and B for 65,000 by bank C 30,000 because they are bringing 30,000 as capital. Okay. Then you come to this revaluation profit. Already we have calculated 8,000 for A and 2,000 for B, right? 8,000 for A. Revaluation upon balance here. This amount we have to transfer to this capital account. Okay. Then by reserve. Reserve already they have given, right? 16,000 and 4,000. Then goodwill how much? 10,000 for A. How much is the capital? Capital is 10,000 for A. Okay, capital 10,000 for A. Then we can find out the balance. Just you put the total here. Here also just you come here. Balance amount which was here this capital account 75,000 and 45,000. 75,000 for A, 45,000 for B, and 30,000 for C. We can write here. Then for A, we will get the balance 4,000, and for B, we will get the balance 14,000. when you are totaling it, for A 83,000, for B 71,000, then for C 30,000. Then we can see the balance sheet as at 1st April 2013, liabilities and the amount column. In the credit side, assets and the amount column. The capital, first we can write it in the liability side. For A is capital, that is the closing balance which was mentioned in the account. A is capital 75,000, B is capital 45,000, C is capital 30,000, right? Total capital is 1,50,000. Creditors 25,000 minus 2,000, which was mentioned in the question, 23,000. Bills payable, they have given 5,000. Okay. Then we can see the furniture value which was given in the question. You can see there furniture 30,000. Okay, just you see the question. Furniture, the assets will be revalued as follows. Okay, so furniture 30,000 we can write here, and the stock 39,500. Okay, debtors 30,000. Then bad debts, less bad debts 1,500. You will get the debtors closing 28,500. Bills receivable 10,000. Then the cash at bank. We will total it all the cash at bank 40,000 plus 50,000. Then 4,000. Then 10,000 and 40,000 we have to subtract it. Okay. 10,000 and 40,000 which we have to subtract it. When you are subtracting, you will get the total here. How much is the total? 1,78,000. Cash at bank also we have find out total 70,000. The both sides total is 1,78,000. Just you put 1,78,000 in the both the sides. Okay. Thank you.